Okay, so today we're going to move forward to Chapter 7, Cost Volume Profit Analysis. Cost Volume Profit Analysis is something that managers use on a regular basis. They use it for decision-making purposes, and it helps with understanding the relationship among cost, volume, and company's profit. And it can also help with determining the sales volume needed to either break even or earn a target profit. Okay, so the components of CVP analysis would be the sales price, and the sales price is really going to be made up of what you're going to be charging for each poster that you're selling. The volume, that's the number of posters that are going to be sold. Variable costs, what we learned in the previous chapters, variable costs are costs that change with volume in total. So the example would be the posters from slide that, maybe the paperwork or the ink or whatever is required to put together the posters. Fixed costs would be like the monthly rent. The fixed costs, as a reminder, those are costs that do not change in total over the volumes. And then once you have your sales price and you can use the volume to compute your total sales and your total variable costs, you're going to take your sales minus your variable costs minus your fixed costs, and that's going to give you your profit or loss. Okay, so whenever we're studying the cost volume profit analysis, we have to remember that there are some assumptions that we're going to have to make. And again, we're always trying to simplify things, so these assumptions, usually they can hold to some level of degree as long as those assumptions are reasonably good or reasonably close, you're good to go. So what's our first assumption? The first assumption is the sales price remains constant throughout the relevant range of volume. Okay? So if we have a relevant range, we talked about relevant range in terms of the fixed cost. You have a certain number of volumes, let's say between 5,000 and 10,000 volumes, then what we're going to assume is that the sales price between those 5,000 to 10,000 units are going to remain the same. So that's the assumption associated with the volumes when we're using CVP analysis. The second assumption we're going to be making is that managers can classify each cost as either variable or fixed. And if you recall what we talked about, there was variable, there was fixed, and there was mixed cost. Well, mixed cost throws a little bit of a monkey wrench into this cost volume profit analysis. So we have to assume that we can take all of our costs and reasonably categorize them as either variable or fixed. Again, it doesn't have to be perfect, it just has to be pretty close. Okay, so the third assumption we're going to make is that inventory levels will not change. And then finally, the last assumption we're going to make is that the product mix offered for sale remains constant. So with these assumptions, then we'll be able to come up with some really interesting analysis and projections. The unit contribution margin is pretty important when we're talking about cost volume profit analysis. So if you recall from our previous chapter, the contribution margin is really the excess of sales revenue over variable expenses. Remember, sales minus variable expenses will give you the contribution margin. So that's what it meant. That's what's meant by excess of sales revenue over variable expenses. Now, what we learned in the previous chapter is we just really kind of focused of sales in total and revenues in total. So and we computed our contribution margin in total. But in this chapter, we're going to learn or we're going to figure out how to compute the unit contribution margin, which is really the same thing except it's per unit. So the textbook would describe it as the excess of the selling price per unit over the over the variable cost per unit. So just like we learned about it in total before in the previous chapter, this one, in order for us to make this all work, we're going to have to break it down per unit. And then we have to remember that all variable costs, product and period costs. So we're talking about both what's part of the cost of goods sold and what are considered to be period costs, which most times we refer to those as general and administrative expenses. So all variable costs, doesn't matter where they sit, must be included when calculating the unit contribution margin. So here's going to be an example of the unit contribution margin, or for K, a unit contribution margin example for K's posters. There's going to be one of three. All right, so it appears that K has an online poster business. She currently sells each poster for $35, while each poster has a variable cost. Of $21. K has monthly fixed costs of $7,000. Her relevant range is 0 to 2,000 posters, and she is currently selling 550 posters. All right, so now we have a pretty good example here where we can get started on. All right, so now we can go on to the second part of the three parts, and we're going to put together a schedule here. So the schedule is going to start with a title of K Martin posters. The title of the spreadsheet is going to be next. That's the contribution margin income statement. And then the period for which this applies to, that would be the month ended August 31st. So we'll start with sales revenue. 550 posters times $35 per poster. And that comes up to 19,000, well, we can actually do the guys. So 550 posters times multiplied by 35 posters gives us a total of $19,250. Less variable costs. Well, they call it expenses, so let's go with that. Less variable expenses, and then the detail is, well, we had 550 posters, and we're going to multiply that by the previous example, or the previous slide said that the costs were $21 per poster. So we'll take that, we'll say, well, it's 550 posters, and we'll multiply that by 21. So now we end up with 11,550, which then allows us then to compute the contribution margin. And the contribution margin, as you recall, it's revenues minus expenses, which gives us a contribution margin of $7,700. From there, we're going to subtract our fixed costs. They call it fixed expenses. And as the previous slide gave us, it was $7,000. And so, given that volume, operating income is going to be the contribution margin minus the fixed costs. So we have a contribution margin of $700. Okay, so the third part, we can then take it one step further and compute what the contribution margin per unit is. Well, we know what the sales price per unit, we're a bit away from it, so we'll come back. Well, we have it here, it's $35 per unit, but that's exactly what they said up here, $35 per unit. So the $35 will go here, less variable cost per unit. Well, we've got it in two places. In the previous slide, we had it at $21, but it was also in our first slide, $21. So $21 goes there. And then what does that equal? It equals the contribution margin per unit. $35 minus the 21 gives us the contribution margin per unit. So what does that tell us? It tells us that Kay earns $14 every time she sells a poster that can be used to do what? Well, it can be used to pay fixed expenses, and once she has those covered, earn a profit. So I like the unit contribution margin per unit because it tells us per unit what we can then contribute to covering both our fixed costs and then adding to our bottom line income. Now, not only can we compute our contribution margin per unit, we can also compute what is called the contribution margin ratio. And the contribution margin ratio really gives us the ratio of contribution, the ratio of contribution margin to sales revenue. The unit contribution divided by the sales price per unit will give us the contribution. Well, I can say that. That's going to be equal to the contribution margin ratio. So K's calculations can be as follows. We're going to take our unit contribution. Let's go look at what the unit contribution was. Our unit contribution margin, or unit contribution margin per unit, $14. I guess that's repetitive, huh? Unit contribution margin. If it's already unit, then you don't need per unit. So unit contribution margin, so it's $14. All right. So we're going to take our unit contribution margin of $14, and we're going to divide that by the sales price per unit of $35. So what is that going to be equal to? So let's do it. So let's take the $14 and we're going to divide that by $35, and we're going to convert this to a percent, and that turns out to be 40%. Now notice that the ratio isn't going to change whether it's per unit or in total. Let's see if we remember. We'll go back up to the previous slide. This is our variable costs. I'm sorry, our unit contribution margin. So let's go up to the total contribution margin. Where's our total? Here's our total contribution. It's $7,700. This was in total, right? So we'll put that here at $7,700. Oops. And then we're going to divide this, and we're going to divide it by sales, total sales. Sales revenue was 19,250. Well, let's see what that computes out to be. 7,700 divided by 19,250, and that'll give us 40%. So you can see it's going to give us the same contribution margin ratio if we do it per unit or in total. It'll be the same. The next thing we can talk about is break-even point. And you know, in many cases, management wants to know, well, what level or what quantity do I have to sell to at least break even? You're going to find that salespeople are really, really interested in this number because, you know, they're coming up with projections of units and prices, and so whenever they're coming up with these units, volumes, and the pricing, they're always concerned that they're going to be overestimating or underestimating, or that they can be off by some. And the pressure's on for sales and marketing people because they have to be really good at coming up with these numbers. Because what you will begin to understand is, particularly when you're in business and you're doing projections, it all starts with the sales and marketing group. We're going to rely on them to come up with the best numbers possible. Particularly the salespeople, they're going to be really interested in, okay, what's my break-even point? In other words, what is the quantity of units I have to sell to at least break even? Okay, so the way the textbook describes it is the sales level at which operating income is 0. Well, break even, that means revenues equal expenses. That means your net income is going to be 0. Break even means 0. Or total revenues equal total expenses. If our sales, if we have sales below the break even point, then what we're going to get is we're going to get a loss. And remember, we're talking about sales. Sales is in quantities. So the number of units that we sell, if we sell less than the break-even, because the break-even is really talking about what's the quantity. So if we sell less than the break-even point in terms of units, we're going to end up with a loss. Any sales above the break-even point is going to result in a profit. So again, we're talking about the quantity. If we sell more in terms of quantity, units, the number of units, if we sell more than whatever we've determined to be the break-even point, the number of units that will just break even, then if we sell more than that, then the result is going to be we'll have some profit. So ultimately, that's what we're looking for, is to make sure we sell at least enough to break even, and then hopefully enough to even generate significant profits. So there are three ways to calculate. There are 3 ways to calculate break even. Okay, so let's see. The first one is the income statement approach. The next is the shortcut approach using unit contribution margin. And finally, the last is the shortcut approach using contribution margin ratio.